Hello, I'm joined by Charlie Gibson from Edison's mining team, who's here to give us an insight into how Indaba was and also take us through some of the main points from his most recent update on gold. Charlie, welcome.
Thank you very much, Julian.
So first of all, tell us about the mood at Indaba.
Indaba, huge mining conference, one of the big three that happens every year in Cape Town. No doubt about it. It was quieter this year than almost any time that I can remember. And there was that same trend we've been seeing for a few years now, where the mining companies aren't going into the exhibition hall. They are going to Cape Town, but then they're not in the exhibition hall, and it's really the service providers who are there. But it was noticeable if you went into the exhibition hall that the aisles were wider, they were shorter, the booths were larger, and where before 5 years ago it was quite a press sometimes to get up the aisles, it was relatively easy. So it was quieter, there's no doubt about it in terms of the number of people there. However, having said that, as I say, they were all in Cape Town, they were all available for meetings, and we had some good quality meetings down there. One thing I think Indaba did unintentionally demonstrate was possibly the depth of the problems of the power supply problems in South Africa. Now, while I was down there in Cape Town, I had no direct experience of it. There were no power cuts or brownouts, or there was no load shedding. However, if you travelled around the country, it was noticeable that there was a much greater frequency of power cuts than I had ever known in my time in South Africa. Within the context that there is in South Africa, it appears that it's being quite well managed, in that if you're in a mine, the power doesn't just go off. They will ring you and tell you that the power is going to go off at 5 o'clock, and you can manage around it. And of course, and that's critical.
The lifts will still work to get your men out of the mine.
Well, yeah, I mean, assuming you have no backup power, but the key thing is being able to shut your equipment and your plant down in an ordered fashion, because unlike in the domestic environment, when the lights go out, when the power comes back on, the lights come back on again. Well, if you're dealing with big pieces of kit, and the power goes off unexpectedly, when it comes up again, they might not turn on in the way you expect, and it can do a lot of damage to your equipment, and it can shorten the life of your equipment from, say, 10 years to, I'm not joking, in some cases 18 months. That's what if you're getting unexpected power cuts.
So extremely expensive, effectively.
Yeah.
Now, moving on slightly, of all the companies you met, are there any that stand out? And also, given this sort of leaner environment, where do you see value in mining companies at the moment?
Value is actually, in some ways, it's not that difficult to identify. And the recent report that you alluded to that we wrote, we looked at 52 gold mining companies, and 2/3 of those are trading below the discovery cost of their resource bases. The other company, the other commodity which we looked at was uranium, and 2/3 of uranium companies are trading at below the discovery cost of their resources as well. And with a little bit of interpretation, we did a similar thing for platinum, and 1/3 of platinum companies are trading below the discovery cost of their resources. So as a marker of where is their value, it is very easy to see value in those instances, because if you imagine, just take away for a minute, whether you believe the commodities are going to go up or going to go down. If you imagine yourself from the perspective of a major mining company, you're thinking, I want to increase my resources by, let's pick a figure, 1 million ounces. Well, I can either go and I can spend roughly $10 million, and I might or I might not find 1 million ounces of gold. But then if I think, well, I can spend $10 million doing that, or if I can buy a company with 1 million ounces for $5 million, well, that's a genuine marker of value, if you like, within the industry. That would give you effectively an immediate return on your money, and an immediate positive return on your money as well. So there is unquestionably value out there.
You seem to be alluding to there being likely consolidation, particularly in the gold sector. Is that really what you expect?
It's certainly what ought to happen. And there is evidence of that as well. I mean, we have had deals. We've certainly seen a number of Chinese consortia coming in and buying assets, buying South African assets recently, South African gold assets. We had the likes of B2 Gold buying Papillon. So yes, I mean, there is evidence of consolidation unquestionably, and that is what what should happen, and I think to some extent what needs to happen as well.
A little more on uranium, perhaps, because in some ways a less complicated market than there is for gold. Everyone expects a big recovery, and they hope that uranium and nuclear power will return to the agenda of countries all over the world. Was there much sense of that down in Indaba?
There was some sense of it. Again, I wouldn't want to overplay the overarching, commodity aspects of it. But yes, I mean, everyone has observed. Roughly this time last year, I think the Japanese said that they were going to turn on their nuclear capacity, and 1 year later, it's noticeable that the uranium price is notably higher than it was. So in that sense, yes, encouraging signs and success. However, again, I think there was an awareness by companies that they had to manage their businesses, almost in the absence of that. That was a positive following wind for them, but nonetheless they were going to have to add value. And how do they do that? Well, one of the things one of the interesting features of the report was, and what it was essentially looking at, is saying times are difficult in mining, we all know that, but where can you add value? Well, one of the areas in which you can add value, on average, is by taking your indicated pounds of uranium in the ground and upgrading them to measured pounds in the ground. Now that's interesting because it's in contrast, oddly enough, to the gold market, where on average, where the value, it's a bit market dependent, but on average, where value is added is by moving from inferred to indicated resources. And the way that I rationalize this, the differences between the two markets, uranium is unusual in that respect because it's very common in a lot of commodities that the value add is moving from inferred to indicated. Uranium is quite unusual in that it's from indicated to measured. And my rationalization for that is that typically a uranium producer will be in a long-term supply contract with an off-taker, a consumer. The consumer, because of the nature of the long-term contract, wants security of delivery, and one of the ways they look to get that is one of the ways in which they seek security is having the measured category of resources in the ground. So in the case of uranium, I think the reason for that uplift in value is because it's being used as a proxy for a potential offtake by the market. And once they see measured pounds, they think, oh, right, well, there's a possibility then of some sort of long-term supply contract. But yes, so that was one of the areas in which uranium was somewhat unusual, but also, offered the possibility of adding value. The other area where it adds value is gold is quite backward-looking as an investment market in that it will give you credit value for resources when you drill them up. But it doesn't really give you value for them before you drill them up. If you say, I've got 1 million ounces and I'm going to do a bit more drilling, and I'm pretty confident there's another 1 million ounces there, the market will wait to see the other 1 million ounces before it gives you credit for it. Uranium, that's not the case. If you can show blue sky, what they call blue sky exploration potential, then you will get value for that before you've actually drilled it up. So one of the things we went around saying to companies was, look, if you can geophysics, aeromag, whatever you need to do in order to demonstrate the exploration potential, up to about 125 million pounds of uranium in the ground, the market will give you credit for that, and therefore you should be highlighting that pretty strongly to the market, demonstrating, there is this potential to increase the size of the resource. After 125 million pounds in the ground, you've got to be a little bit careful. It might be value destroying. I'm not saying you don't want to increase the size of your resource beyond that point, but take it tentatively and don't assume that it will necessarily be value adding just because it's larger, because actually there's quite strong evidence that beyond that point, larger resources do not attract a higher rating.
Charlie, thanks very much. And if you'd like any more information, please visit the Edison website.